The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday, the 27th of June. Morning, Jeremy. Good to have you back.
Hi, Gareth. Good to be here.
So it's been a fantastic week once again in terms of goings-on the world stage. It'd be great to get your view on the macro situation and what Trump's been up to and what he's achieved. And then we can talk about the UK. So what do you think's worth thinking about first?
Well, World War III is over before most people even thought it started. Oil prices are plummeting. Inflation is dead. Daddy Trump is putting the world back together, including doing a trade deal, so we're told overnight, with China and several others in the pipeline ahead of the July 9th deadline. And he's determined to get interest rates down, even if it means completely undermining the man who is getting in his way at the Fed. And to boot, the UK smaller company sector has discovered the Bitcoin magic money tree and is bathing in the prospect of free money. So as they say, what a time to be alive. What could possibly go wrong?
Yeah, what could go wrong in any of those things? So let's unpick it. So yeah, as you say, the Iran situation seems to have calmed down almost as rapidly as it heated up. Trump taking credit for lots of obliteration of various nuclear facilities. How true that is, not entirely clear, but certainly he's done a lot of damage to the facilities.
Yep. And
in the process, reassured markets that it seems to be done. Oil price, as you say, is declining. Straits of Hormuz remain open.
Yeah.
And it feels like that's under control. And that's the way the markets have reacted, isn't it?
So much for taco, eh?
Yeah, that's true. It's shown as metal there. Yeah.
And I think you're right. And I think the oil price is the main gauge to watch. I think the other one is the dollar. And I think both are indicating that the world structurally is long of both. We have plenty of oil and probably too many dollars. And hence, once the Iran situation was felt by the market that it had been put to bed, then both the oil price and the dollar have resumed their downward march. And the dollar weakness is the one that we should be maybe concerned about. But that's something that I think is likely to continue, but obviously not investment advice.
No, but it is interesting. And the dollar was also weakened a fair bit when Donald Trump rattled the saber once again in the direction of Jerome Powell, having seen off Iran.
Yes.
He's now looking to the enemies within.
Yeah. The bunker busting bombs are aimed at the Fed now. Yeah.
That's right. But the dollar did slide, I think, quite dramatically when I think Trump was talking about choices for Jerome Powell's successor.
A full year ahead of time. And the idea seems to be emerging that he's going to appoint a shadow chairman or a shadow FOMC to undermine him. But obviously it's not a good look, and so much for central bank independence. If people needed any other reasons to feel they were probably slightly overexposed to dollar assets, if you're a global investor, here's another reason.
No, that's right. And I think in that vein, there's been a bit more news from the UK, various people who should know about these things, suggesting that there's been a steady flow of capital towards the UK, and this sort of, diversification away from the US is continuing. So, and we are, I think, continuing to see the benefits of that actually in terms of the UK listed equity market. There has been, evidence that it has been performing in various pockets.
Definitely, yeah.
But as you say, that the big news this week in terms of the UK, I think, has been the sudden realization that what the Americans have been watching for a while in terms of MicroStrategy, now renamed Strategy, and the Bitcoin Treasury model has suddenly arrived on our shores. So very interested to get your take on that and see what we think.
Yeah, it's interesting how it's happened and when it's happened, but there's no doubt that the UK smaller cap sector has unlocked a gateway into the crypto universe of magic money. The IPO of the Smarter Web company that we've talked about previously hit briefly a valuation of £1 billion 6 weeks after IPO by adopting the MicroStrategy, now strategy for those paying attention, and adopted Bitcoin as its treasury reserve asset, and promptly accessed via an OTC listing access to a new form of capital that hadn't been accessed by the UK market from this sort of twilight world of crypto meme stock enthusiasts that are sitting on lots of capital. And basically, the Bitcoin Treasury strategy is one that allows people who only invest in regulated listed securities to get access to Bitcoin. So part of the phenomenon that we're seeing here is the constriction that has formed this bubble, I would say, is at least partly the responsibility of the regulators. Because until now, if you have a self-administered SIP or ISA, you haven't been able to buy Bitcoin because it's deemed to be too volatile, therefore too risky for the likes of you and I to own directly. Mm-hmm. And in that end, the regulators associate risk with volatility, which I think is part of the problem.
So essentially what's being said is that these companies, whether it's Strategy in the US or now the Smarter Web company in the UK, are cleverly accessing large pools of capital or investor appetite for Bitcoin or non-fiat currency based assets. Investors want those things, and they are funneling that capital into these companies because that's an easy way, or maybe the only way, in which they can deploy their capital into those sorts of assets. And that's bringing down the cost of capital for the companies that are involved in this. And it's a good thing for those businesses, and potentially one way or another, a good thing for the world. That would be the view.
Yeah, I think there's lots of people who will disagree with that view. There's lots of people who'll see a bubble and they'll explain all the reasons why it's bad for you, that people will lose money, it shouldn't be allowed to happen. But as the great investor George Soros says, when I see a bubble, I run towards it. And I would argue both lived and worked through was the dot-com bubble. What that bubble pointed to was a thing called the internet, and today is Mag 7. What is it they say? The market overvalues technological change in the short term, but undervalues it in the long term. And I think in the case of Amazon, which in the late 90s, early 2000s was considered a nearly bust online book retailer, was massively undervalued in those days compared with its long-term potential. So I'm not saying that this Bitcoin thing is necessarily going to be as big as the internet, but I think it is something that is emerging, as you say, as an escape valve from the fiat world that the world is quietly been adopting for whatever it is now, 16, 17 years. It's been pilloried for all kinds of different reasons, and it's proven itself to be resilient. And it happened that in the last few weeks that a smaller company in the UK has sort of opened this escape hatch into the Bitcoin world, and it's discovered a bubble. But how big this bubble will become, what direction it'll end up going in, and what it will leave us over the long term is yet to be determined.
Yeah, I come at this with a traditionally skeptical, cautious view. And at the moment, I'm struggling to see where the real value is being generated. Sure, it's a great way of companies accessing a pool of capital, a group of investors who would love to invest in Bitcoin style assets, but can't for various regulatory reasons. So the companies that are exploiting that, that's good for them. They get a sudden inrush of cheap capital. But until I see what they're doing with that capital, where they're investing it, or what their long-term plans are to create genuine shareholder value, I'll be worried. And perhaps there is a MicroStrategy, now renamed Strategy, model of becoming a global leader in managing these type of capital flows and allowing certain investors to invest in assets they're for regulatory reasons precluded from. But I can't see UK micro-cap stocks of all sorts suddenly becoming experts in global financing mechanisms. So I'm still slightly unsure where the long-term value creation is going to come from, albeit that I can understand it's a very clever way of tapping an unusual and a constricted form of investor demand. But I guess we keep an eye on it.
I agree with all of that. And I think there is no doubt, like all bubbles, it'll attract charlatans and incompetent people who won't know what to do with the capital once they've got it. The dot-com boom was full of those sort of people. And I think that's where one has to look at these things with your eyes wide open and being selective on how you play this, if you choose to at all or not. I think it's perfectly legitimate to avoid the first phases of the bubble. If you're a long-term investor, stay away. I think you've got to know what you're looking for and what your time frame is. And maybe the answer is that Strategy, formerly MicroStrategy, it's a 100 billion market cap company. It owns 60 odd billion dollars worth of Bitcoin. Why bother owning a UK microcap company replicating that strategy when you can own someone who initiated that strategy, where it's pretty difficult to imagine a situation where anybody will be able to catch up in terms of scale and sophistication with what Strategy is actually doing.
No, it's true. There are not many successfully launched other online book retailers since Amazon.
Exactly. But I think what it's signaling is that there will be lots of other second and third order consequences of what is happening here. But I don't think there's any going back, in my personal view. While Bitcoin Treasury companies might be in the Ponzi category, Bitcoin itself has passed that tipping point where I think an increasing number of people no longer believe it is itself a Ponzi scheme.
Yeah, be a fascinating space to watch over the coming months.
So back in the normie world of traditional finance, what have you been looking at this week in UK companies?
In the companies that still bash metal and make widgets. Life's going on. And actually, on the progressive client base, we've had a great week, actually. We've had 3 bits of news, all of them positive. We had Sanderson Design Group. They gave us an upbeat AGM statement. They're involved in the luxury end of interior design and furnishings, and they're saying that trading's been in line. Net cash is building nicely. And actually, some of the tariff-related pressures that they previously talked about, those are starting to ease. So that's pretty good news all round, and they're seeing that across all of their geographies, and they're active in the UK, the US, and across mainly Northern Europe. So nice to hear some positive news from Sanderson Design Group there about a number of geographies. We also had Gear4Music, the online retailer of musical instruments. They reported their FY25, the year to March. That itself was in line, but more important really was the fact that they're talking about the start of FY26, and that's got off to a flying start, double-digit sales growth and improving gross margin. So they've been through some tough times over the last few years, Gear4Music post obviously the COVID bubble and then the retracement from there. But they've cut costs, they're running the business, I think, very well, and they're certainly seeing the benefit of that in the early part of this current financial year. So good news from Gear4Music. And then finally, Vertu Motors, the car retail group, they also had an upbeat and pretty positive AGM statement. Clearly, the auto markets have been pressured for all sorts of obvious reasons for a while, but Vertu does seem to be doing okay. They're also keeping costs down. I think they're benefiting from their service business, which is higher margin than the pure retail side, which is growing really quite nicely. And then we also had a pretty positive trading update from Inchcape yesterday, where they talked about the market more broadly. And again, it's nice to see that across that whole sort of UK automotive sector, things are at least stabilizing or even potentially slightly recovering. So that's great to see. So yeah, nice batch of news items from the progressive client base this week. And then looking forward to next week, what have we got on the macro radar?
Well, it's jobs week in the US. We got non-farm payrolls on Thursday, which is always a bit of a crapshoot. But we're expecting to see a figure close to 100,000, which would represent a continued cooling of the labour market. I think the stock market, all equity markets, are in a risk-on mood at the moment. So bad news is good news, i.e. that will mean Donald will get his way sooner. One way or another, we'll get lower rates. And I think weak employment data will just fuel that fire a bit. We're also going to get inflation data from Europe, with the Eurozone rate likely to see another month at or below its 2% target. So while we and in the US struggle to really get close to target, the Eurozone is already there. But I think really headlines are going to remain dominated by a certain Donald J. Trump. And I think it's going to be dominated by news on trade deals. They're promising one on China. Lutnick has said there's 10 more in the pipeline. And the big one is going to be with the EU. So I think that's what we're going to be looking at.
And Japan, hopefully somewhere in the mix. It'd be nice to see.
Well, yeah, maybe one day.
Fingers crossed. Okay. Great chatting, Jeremy. Good to talk to you. And we'll speak this time next week.
Okay.
Talk to you then.
Bye for now.
Brought to you by Progressive Equity.